Hey Jeff, welcome to the inaugural video for Simplicity Investment Watch. Well, the election is over and the markets are very happy. Not necessarily for who won, the money really didn't care. The election was uncertainty and the markets hate uncertainty. So also last week, the Fed cut rates another 25 bips or 0.25% down to 4.75%. And now, as we head into the holidays, the Santa Claus rally is looking to be a promising one. For anyone watching this video who is not Jeff, let's go over what we are and the purpose of the site or channel. I'm Mark Goucher, and Simplicity Investment Watch is first a platform that allows me to share investment considerations with my investment partner, Jeff. Secondly, to all others, not being Jeff, it's an investment educational service. Jeff and I use a combination of stocks and options, different strategies to attempt to enhance our investment returns in the short term. I'll talk about a few of the common strategies we use, but first I just want to briefly go into what are options. I don't want to go too far down too far down the rabbit hole in explaining that, but if for those of you who have no background whatsoever, I just want to give a general overview, and then I really encourage that you look it up online, watch other YouTube videos that go into greater detail. But for the sake of brevity of this video, um, I just want to give a brief overview on it. Okay, so basically, options are a contract to buy a stock at a particular price, and within a certain time frame. They have an expiration date. What I can compare it to most closely that a lot of other people can relate to is a housing contract, or a purchase agreement. You want to buy a house, you make an offer for $500,000, you lay money down for the ability to have the right to buy that house for $500,000, and if the seller accepts that, you have your 30 days or whatever is stipulated in the contract to get the deal done at the price of $500,000. And that's very similar to what an option is. You can pick, you look at this chart right here. This is PayPal. PayPal is currently trading at $86.54. Say I wanted to buy, I think this is going to keep going up, and I want to buy a contract at the closest point that there's option contracts available for this. So let's just say $85. So I buy a contract for $85. As long as now I now put a contract out onto the market where someone buys that contract, and that means that I now have the ability to buy this stock at $85 for a set period of time. Options, there's weekly options, there's monthly options. You can buy options for a year out. You can buy an options for 1 week out. There's all types of variables. But so you state based on the contract you wanna buy. You state the price that you're interested in, and the option also dictates the time frame that you have for the right to buy that stock at or buy PayPal at $85. And that's basically your call. Of course, what do I want it to do? I want it to go to 90. I want it to go wherever. So 100. I have the ability to buy it at 85, and therefore, if it does go to 90, I have that price appreciation without actually owning PayPal. To own PayPal, if I wanted to buy 100 shares of PayPal, I'm talking $8,600. Or I could go out there and find one contract that each contract for options covers 100 shares. And you can get it for pennies on that, meaning like say it's 50 cents. It's 50 cents and it's 100, the contract represents 100 shares. So that's basically $50. I don't know if that's the exact option price on PayPal. I can look it up, but that's kind of the difference you're talking about. I can buy the rights to buy PayPal $85 for maybe $50, whatever, maybe $100, or I can go buy 100 shares of PayPal for $8,600 and wait for it or hope for it to go to 90 Yeah, you can make a lot of money if you own it outright, but you can also make money on the option contract, the ability to buy that at 85 when it's at 90. So there's money to be made on that end. On the put side, you're betting things are going down. So I could buy a put. Say I think PayPal's gone way too high right here. It's gonna go down. Um, I can buy a put. And basically what I'm saying is I'm buying a put at $85, and that means when I buy that contract, someone who on the other side of that contract who sold that contract is basically agreeing to accept that stock from me for $85. Now, I don't even have to own the stock. The contract just allows me to say, I'm taking ownership of 100 shares that I don't have, and I can sell them to somebody else that's agreed to buy them. So now if the stock goes to 80, well, I can buy it at 80 on the market and sell it for 85 on my contract because someone else has to accept it at 85. So it's ability to make money when the stock goes down. So that's basically your calls and your puts. Now, you take those two, and what the two very typical strategies that Jeff and I use is like taking those options, but also combining it with the actual ownership of the stock. The first one's a covered call. So the covered call is like in this instance with PayPal, I'm going to go ahead and I'm going to buy the stock. I'm going to buy it today. I'm going to buy it for 80, whatever, what's it trading at? $86, 86.62, doesn't matter. I'm going to buy it for $86. Um, and then I'm going to not buy a call. I'm actually going to sell a call. Now, when I sell the call, I have the obligation to give up those shares at the call price that I bought. Someone else on the other side of the contract has the obligation to take them from me at the sell price that's written on the contract. Now, what I'm going to do is the price is at 85, just say for the sake of this conversation, I'm going to sell a call at 90. Well, that's great. So if that happens, if it moves to 90, I get $5 appreciation in the stock. When I sold my call to that other person, they're paying me for the right to take that stock away from me at 90. So I'm getting money for that. So I got money for the right for someone to take it from me, and I get the money for the appreciation of the stock moving from 85 to 90. So it's a win-win. You win on both sides of that on a covered call strategy. Now, it can go south on you, the stock can go down, that's fine. Well, the other person's not going to exercise the contract because it's no good. You still made the money on the contract, that's fine. The contract expires, it has a time frame, it has an expiration date. The expiration date can be very short. It can be this Friday if you wanted. Right now it's Monday. So I can let that expire and I can move on. And I still own the stock. So I'll sell another contract. Say it goes from 85 down to 80. Okay. I'm at a loss technically in the stock, but you know what? I still have confidence in PayPal. I still think it's in an uptrend. We can see it right here. It's been in an uptrend since August. I still think it's in an uptrend. And so I'm going at 85. I'm going to sell another contract. I'm going to sell a contract at, well, I own it at 85. It's gone down to 80. So I'm going to sell another contract just above 85, right? So I make money again. The contract pays me. Someone has the right to take it away from me at whatever I sell it at, 87, 80, something above my price. And so I made money again on the contract. And this time, if PayPal actually moves up to that price, they can take those shares away from me. That's fine. I made money on the stock itself, and I made money on two contracts if that was the scenario. So it's a covered call is a very interesting way to enhance your returns because you're actually getting money for just giving someone the right to buy it from you at a set price. The other strategy is it's like a covered call, but one more leg to it, one more little nuance to it. It's called a collar strategy. So you buy the stock. So I buy PayPal at 85. I sell my call at 90. But when I sell that call at 90, I'm getting money for that. I talked before, maybe the calls were 50 cents. So I get for 100 shares, I get $50 payment from this other person on the other side of the contract. Maybe I own more than 100 shares. Maybe I own 500 shares. So I'm getting $500 from the other person on this contract, whatever it comes out to be. But I'm using that money to actually go off and buy a put. and that provides me my insurance. So I buy my put at 80. Just for example, it could be someplace else. It could be 82, depending on what the charts are telling me to do. I technically would probably want to set it right around the top of this candle, below this candle for today. So 82, 83, say 82. $82, I sell, excuse me, I buy a put. Now I have the right to push that on to somebody else at $82. The other person on that side of that put contract has the obligation to take it at $82. So that way, if it goes below $82, I have a guarantee floor on this 82. It doesn't matter how low it goes, I can always sell it at 82. So that's my insurance. So I own the stock. If it goes up, I sell the call. I mean, excuse me, I buy the stock, and before it even moves, I'm selling a call, so I have that premium. I'm using that premium to buy insurance on the downside. So now I have a floor on this, and I can move forward. If it goes sideways, you can do that all over again. In other words, it doesn't hit the 90, it doesn't hit the 82, it just moves sideways. I can do that all over again. But that's basically the two strategies that Jeff and I use, a covered call or a caller strategy, predominantly, mostly. I mean, it doesn't mean that's the only strategies. There are other ways to go about this. You can buy an outright call, you can just buy an outright put. There's other ways to go about this. But as you know, the name of this site is Simplicity Investment Watch. We do try to keep it simple, and I'll get into that in a little bit. And so actually, no, I'll get into it right now. So Simplicity Investment Watch, and I'll focus on the word simplicity. Why? Hold on, turn this off. Why? So Leonardo da Vinci said, simplicity is the ultimate sophistication. So there you go. Keeping things simple is really smart. Even though it might seem basic, it is really smart. And with options, out on Wall Street, all the firms, they get into multi-layered strategies with options. You can do that. You can make this very complicated and sophisticated. They have the staff to do it. They have the supercomputers and they have the algorithms. Great. But here we are, just common investors, and the idea is to, just keep it simple. But obviously the goal is to enhance your returns and make more money than just owning the stock. But basically keep it simple, because you, quite frankly, don't have the time and the resources to do it otherwise, and quite frankly, nor do I. So simplicity is the ultimate sophistication. So basically, what I do is I'll run screens daily. I have them set automatically. They come to me at the end of the market day. There's filters and other research that I use to find stocks that I consider are good candidates for our strategies, and I share these with Jeff through this channel. Soon to come, I will have a website. It's simplicityIW.com. It's not live yet. It's under construction. But once I have the website up, these videos will be on the website. And there'll be other value-added information, which I'll get into at the end of this video. All right, so you ask, why don't you just call Jeff and share this? Well, many have expressed the desire to watch over our shoulder. They want to see what we're doing in our trading. They heard about the trading. They're very interested, and they want to know what we're doing. So ergo, the creation of Simplicity Investment Watch. Let's talk a little bit about who we are. So we are two regular guys who take interest in investing on the side. The investments that we do are not primary income, and they are not we are not investment professionals, nor are we licensed in any way to give financial advice. In a past life, I held the license and or the roles of financial advisor, investment analyst, and even trading manager for a small firm. However, I'm not currently licensed, and we do not offer investment advice. Let's go into our style of investing, our flavor, so to speak, and what we're looking for. So the chart right in front of you shows again, we're looking at PayPal, shows basically PayPal was kind of going sideways March through, and actually I could move the chart over some more, maybe even longer, but let's just say here, what we can see here is that between March In August, it was going sideways. August earnings came along, and boom, must have been real good news because the uptrend started. And here we go. So since August, this has been an uptrend. So this is what I'm looking for. My screens are set up to identify these, and basically we try to identify the trend, and then ultimately I want to find an area of consolidation, because the concern has always been like, okay, at what point am I buying too late in the trend? And I'm just like one of the last guys in the merry-go-round, or the music stops on the musical chairs. So no one wants to be that guy. So basically, you're looking for an area of consolidation. So, okay, wait, this trends do this. Nothing moves in a straight line. It goes up and then it zigzags down. That oftentimes, what I identify may be a time for us to step in, because it's usually setting itself up for the next leg up. And as you can see in the chart, it did. So it started going on its next leg, and then it did some consolidation again right here around end of October. And boom, it's here we are early November, and it's been moving up for another leg. How long this leg goes on, we don't know, but that's what the game's all about, right? So we are all about the right price at the right time. What makes us more swing and less trend by definition is that we tend to take larger positions for short periods of time and utilize leverage or derivatives to attempt to enhance our investment returns. I primarily do this through technical analysis, which is basically reading the stock charts, a little bit of what you're seeing right here in front of you, and not the balance sheets. Although analyst opinions are part of my vetting process, we pay little regard to fundamental analysis, at least as far as us conducting fundamental analysis. I rely on others to do that. So I let the analysts give their fundamental findings, and I go with that while I do the technical analysis, or I do my chart stuff. So now that we covered what we are, let's disclose what we're not. Okay, so first, let's level set the room. I'm not a professional social media influencer or a YouTube presenter, so go easy on me. I'm just a guy who works with an investment partner and has been asked by others to share what we do. This is me sharing. As far as our disclosure or legal disclosure here, we do not give financial advice, and this information is not for investment decisions. This is for educational purposes. The stock market is risky, and any trade or investment is expected to have some or total loss. The use of derivatives increases investment risk or potential loss. Do your own research before any trade. Please consult a financial advisor or professional to determine what is a suitable investment profile for you, given your investment goals and objectives. All right, this inaugural video basically is to cover the who, what, how, why of what we do. I'm going to share the technical indicators, some tools, screening tools, and research process or vetting. Going forward, the videos will be much shorter. Hopefully in a 15-20 minute window, I can share what I'm finding on a daily basis. But they'll get right into what is of interest and what is to be considered for investment purposes, and basically what is moving on to or off of my watch list and action list. So let's dive into the technical research, and let's answer the question first of all: is what stocks are we screening for? Okay, what we screen for is a lot of the criteria that you see right on the screen. I have I use various services to deliver a list of candidates to me at the end of the market day, and these are some of the parameters I set up in that. Some of this is just information that's shared with me. It's not a filter, so to speak, whereas some of them are filters. So one of the filters is price. I want a stock between $10 and $250. Why 10? I don't want anything under 10 because they're considered penny stocks. The reporting that is done on penny stocks is not always as comprehensive as stocks that are higher priced. There's not as many analysts that are looking at stocks under $10. It doesn't mean if you own a $5 stock, I'm telling you, you're a fool or anything of that nature. That's fine. It's just that for what we do and what I want to look at, I want to stick with stocks that are over $10, just knowing what I know about the industry and trading. The upper end of that range, that's only a limitation based on your portfolio size. $250. Hey, if you want to buy a stock and you want to sell an option against it or buy an option against it, whatever it is you're looking for, options represent 100 shares. So you want to own 100 shares of the stock and then sell an option that represents 100 shares, right? So at $250, you're talking 100 shares is what, $25,000, right? You need a portfolio that's big enough, and you don't want that $25,000 to be your entire portfolio. For the record, also, your portfolio, anybody doing this, that money should be risk capital. It should be speculation money, your Vegas money. This is not really what you want to be doing in your retirement account or the money you need to pay your mortgage. So, but all that said, whatever the size of your account is, that's going to kind of determine the upper range of what you're looking for. For Jeff and I, 10 to $250 is that range that works well for us, and that's what I'm screening for. Market cap, okay, the size of the capitalization of that particular stock on the market. Basically, market cap is the number of shares you have out there times the current trading price. I'm looking for 300 million plus. That gets me in the range of small cap to mega cap. Basically, what I'm eliminating is the micro caps for the same reason that I don't want stocks under $10. They're not as widely followed. The reporting is not as up to date, current. There's just, and sometimes it's just outright misinformation. So I don't want to deal with it. So it's 300 million plus small cap to mega cap. Option volume. Volume's very important in the pricing of what you're buying. So let's talk about stocks. There's always an ask and a bid on the market, right? So the ask basically is, hey, I want to buy your house. How much are you willing to sell it for? Oh, I'll sell it for $50 a share. Oh, okay. That's your ask. Now your bid is, hey, I want to sell my house. How much will you give me for it? Oh, I'll give you $45 a share. There's your bid. So what happens when the volume is low, that ask and bid sometimes gets to be a very wide range. So what happens is if you go and buy it and you're buying it close to the ask price and you have to sell it almost immediately, the bid could be a significant percentage away, and you automatically earn a loss from the moment you bought it. So volume is a key component of keeping those ask and bids very close. And so that being the case, option volume is the same way. So what I'm looking for is option contracts that on a daily average over the last 6 months, that they've been trading at on average more than 10,000 contracts a day. That pretty much gives you all your big names. And that just helps me keep pricing tight so that we're not immediately stepping into something where, oh my gosh, we got to sell it the next day and we're selling it for a loss just because of the spread. Never mind market forces. So that's the deal with volume. I want weekly options. Options used to be, way back in the day, they used to be once a month on the third Friday of the month they expire. So it's now November. This Friday is the third Friday of the month. But if I wanted to, say, buy a call, I would either be looking at this Friday of the month, or I have to jump all the way to the third Friday in December for my next option contract. That's no longer the case. Options have become more common, very popular, and the market makers have created basically these weekly options, not on every single stock. And that's why I screen for it. I want to know that the stock that I'm looking at does have that option to have weekly options. It does have that ability, or does offer weekly options. So yes, I want weekly options. That way I can implement a strategy for this Friday if I want to, right? I can implement a strategy for 3 weeks down the road, 4 weeks, whatever. So it gives us a lot more freedom as to how long do we want to time this or work this out in terms of not being stuck to just the third Friday of every single month. So weekly is part of it. IV rank and IV percent. This is something I'm just going to kind of It's a lot to talk about this, but IV is implied volatility. So options have a options volatility is a component of pricing an option. There's a certain way that that this is done through what's known as a Black-Scholes model. Again, I don't want to go too far down the hole here, but basically the IV rank, the implied volatility rank, and the implied volatility percent of a stock helps is a factor that I need to see on paper, and it helps ultimately to decide whether this particular option is good to buy right now, meaning it's high historically for itself, or is it a good thing to, um, excuse me, I said that backwards. If it's really high, the price is really high, it might be something that I want to sell right now because it's at it, you sell high, or if the volatility is low and thereby the price is low. Um, and again, there are other factors that go into this computation, but just for this conversation, if the volatility is low and the price is low, maybe I want to um, buy that option. I want to consider, excuse me, consider that option for purchase. So IV rank and IV percent show up on there. IV rank basically is where it stands compared to the highest and lowest values over the past year. It goes from 0 to 100. 100 means that it's at the highest level over the past year. IV percent is the percentage of days with the implied volatility closing below the current level over the prior year. So basically, a stock can have um, a low implied volatility percent, say a 40. Yet because the stock is not volatile, that 40 could give it a ranking of 95, meaning over the last year it's actually sitting on the high end of its range. So it just helps to get a better sense of, are we looking at a low volatile stock that is currently very volatile compared to itself, which is maybe something I want to sell, you get premium for, or are we looking at a highly volatile stock that is currently very low compared to itself, which is maybe something I want to consider buying as an option, so that's why they're on there. Um, the other big factor on this, and I don't really screen for this, but when it comes into consideration as to whether you're buying or selling an option, is time factor. As I said, contracts have expiration dates. As you get closer to the expiration date, they lose their value. So that's known as theta. Time is known as theta in the options world. So I'm looking at vega, volatility, and theta as a couple things, but most importantly, volatility shows up on my screens. So paying a higher price is something obviously that you want to try to avoid when buying, and something you desire when you are selling an option for income. When we go into covered calls, we end up selling an option against the stock that we bought to get premium on to get paid the premium on that option that we sold. So we want to sell options that have meaningful value. So I look for an option or options that are over at least 50 cents or higher. Even dollar or more would be great, and just to make it worthwhile. We obviously So basically, what does 50 cents mean? So 50 cents on an option contract. Well, I said an option covers 100 shares. 50 cents is technically one share within those 100. So really, when you're selling or buying an option that's at 50 cents, it's that times 100. So it's really $50. If I wanted to sell it, I could get paid close to $50. If I wanted to buy it, I'm probably paying $50. So that's what the 50 cents means. So if we're going to get revenue, and we want to do this on a few option contracts, maybe get 50, 100, $150, I could technically sell an option today on a Monday that's going to expire this Friday and get $50, $100. And as long as, and maybe I get the stock called away from me, it doesn't matter. But I have that revenue on a Monday that expires on Friday, and I get to keep it. So I just, you just made $50, you made $150. If you get into multiple contracts, the sky's the limit on it. But or at least your portfolio is the limit on it. But there's money to be made in the short term when you look at it that way. So below the IV rank and IV percent, analyst opinion, again, I want to see that. The analyst opinions, the way I have them delivered to me, are on a score of 1 to 5, 5 being the ultimate best stock, 1 just being awful. But I want a 3 or higher. That way, if I do end up owning a stock longer than I intended for these strategies, at least we know we own something that is worthwhile. Um, I always compare it to like owning an apartment building. If you own a quality apartment building and you bought it and you want some price appreciation in the building and you're collecting all the rents for people in the building, so the collecting the rents is like collecting the money from the options, right? So, for the analogy. So and then you want to sell the building at a higher price eventually to another investor, a real estate investor, and they get all the rents. So, but I need to know that at least the building that I own is going to sell. I didn't buy some, money trap. So that's where the analyst opinions come in, and that's on my screen. And then just market sectors. I'm looking at 14 different sectors just for diversity purposes. So I get all these screen results from multiple servers that I use at the end of every market day. I then go through my vetting process, and usually I can add about anywhere from 2 up to 10 stocks to my watch list based on my research and my vetting of that list. Uh, then or that I then use daily that watch list I use daily to find stocks for my buy or action list. All right. So now let's go into the technical cornerstones of there's three things that I predominantly use in my decision making, and I just kind of want to cover those in this video. I won't go so deep into it and other when I start when I actually start talking about what we're implementing or what we're acting on, but I do want to cover the technical cornerstones in this introductory video. The first one I want to go into is what's known as the TTM squeeze. Um, so basically TTM squeeze is on the bottom of this chart right here. And it was developed by a gentleman by the name of John Carter. It helps to identify when prices move into consolidation and then when they're breaking out, which is exactly what I'm looking for. I want a trend. And quite frankly, the trend could be a downtrend, and you can make money on that with a put strategy, but without overcomplicating things, let's just stick with the uptrend because that's the way most people think. Um, I'm looking for an uptrend. I'm looking for consolidation, and then I'm looking for that trend to resume. And actually, the TTM indicator was pretty much designed by John Carter to do this. Um, it uses Bollinger Bands and Keltner channels to do this. And the TTM squeeze is when the Bollinger Bands move inside of the Keltner channels. This indicates a period of low volatility. So the indicator has a squeeze, and then these dots down here, they turn red. That means squeeze, and that's something I filter for. That comes up in my screen, like, okay, this stock just entered into a squeeze period. The volatility is very low. It's in a consolidation period. Um, so the Bollinger Bands basically look like this on a chart. Most of the times Bollinger Bands are set on a 20-day period. This is a daily chart, so this is a 20-day moving average, this center line. And then your Bollinger Bands are set at 2 standard deviations from that 20-day moving average, and the 20-day moving average becomes the mean for you math geeks out there. So your 20-day moving average is your mean. 2 standard deviations is the channel that's being offered here, and if the stock price becomes consolidated, these bands constrict. So there's low volatility, therefore 2 standard deviations represents a smaller range than it does when there's a lot of volatility. But what that does is ultimately, mathematically speaking, 95% of your data points, so these are all closing stock prices, 95% of your data points are going to be within 2 standard deviations of your mean they're going to be within 2 standard deviations of your mean. So when you have data points outside of the Bollinger Band, there are either periods of times where just because the math of it is it's either overbought or oversold, and it's going to move back into the channel. Most recently, this was like a classic one right here. This candle, and let me go back to the candle. This right here, this close was a sign. And again, I'm looking at it retrospect, but that was a classic. Moved outside of the Bollinger Band. It's in an uptrend. It's oversold. Time to buy. and you would have taken it right up to where it is today. This last candle is today's action, and as of right now, the market is closed, so that's a closing value. So let's just say you bought it the next day and you took it to the close today. You got 11.65% in 6 days from the time that that stepped outside of its Bollinger Bands. So again, it doesn't always work that way. That's a beautiful example, but anyhow, that's kind of what you're using your Bollinger Bands for. And then the other factor that's used in this calculation for TTM is your Keltner channels. Your Keltner channels, they don't work off standard deviation necessarily. They work off of average true range, ATR. Not going to go into it. The bottom line is they are both measures of volatility. And John Carter kind of figured out, well, hey, you know what? When these Bollinger Bands move inside of these Keltner channels, so the pink moves inside of these dark blue lines, that is a period of exceptional consolidation or low volatility. And therefore, I'm going to call it red dots squeeze. I'm going to call it a squeeze. So that's what I want. And then I assess. Let's turn off the Bollinger Bands and the Keltner channels because I don't look at those after I have the information that it's in squeeze. When it comes out of the squeeze, it is said to have fired. The volatility is increasing and the squeeze dots go green. So that means that it's moved out of that consolidation stage. On this particular chart, it went green right there, this candle. So you can see the pop. And had you acted on that immediately, and I may or may not have, but because there's other factors to consider, but had you acted on that, it actually probably would have been a pretty good trade. Because even if you got it at the high of the day or the close, again, today it's up 12% over 38 days from the time that pop happened. So that's what I'm looking for in the TTM. The one other factor of the TTM that's kind of interesting is there's a momentum histogram down here. You see these waves. They basically, it's a measure of momentum. John Carter says that you really want to, so after one or two red, if you see a green, you want to act, and you also want to act in the direction of the momentum, which is what these momentums suggest. Doesn't always work that way, but that said, it would have on this one. And he also says that the fire, meaning that it turned green, the fire tends to last about 8 or 10 bars. So you have, on a daily chart, you would have about 8 or 10 days on average, basically what he's saying, that you can expect to make some money on it. There are times here where it was in the red over here. So this was the squeeze. It went green. That green with the momentum pointing down or red would have told you that you wanted to short this or sell it or buy a put. And quite frankly, it would not have been a good call at that time. So yeah, it's not perfect. Nothing is. But I don't use this alone. I use other factors to make a decision. And on that note, let's get to the second technical cornerstone. And that is what is known as anchored VWAP. Yeah, what's that, you say? Well, basically it's a technical tool that is the perfect combination of price, time, and volume. To use the words off of the cover of Brian Shannon's book, and the best book I ever read on the subject of VWAP or anchored VWAP is Brian Shannon's book, Maximum Trading Gains with Anchored VWAP. Basically, VWAP, not anchored VWAP, let's just talk about VWAP first. VWAP is an acronym for Volume Weighted Average Price. So it combines volume and pricing, the number of shares traded, add in the volume, and then get an average. So it's a volume weighted average price, and it is the cumulative average price of a stock traded during one day. It resets every trading day, very widely used by day traders. Basically, it's the sum of the price times the volume at any particular price, all divided by the sum total of all the volume up to that point in the day. So a day VWAP, just real quick, will look like this. Let's say we're looking at a 5-minute chart. let's give this a little more time here. All right, let's go like this. These are all different trading days. This is the start of November 6th, it going through today. And then let's add a VWAP on this. And let's make it red. Yeah. Okay. So the VWAP sets every single day. You can see it doing it here. So back on this day, stock opened up. Your average price, the cumulative average price was the line was set here. The price action went below it. That means sellers are in charge, and that's basically what VWAP is, an anchored VWAP. It tells you whether the buyers or the sellers are in charge, and it's a beautiful tool. Once I learned about this, so basically on this day alone, as we go through the morning hours on the 6th, sellers were in charge right out of the gate. If you were a day trader, you were shorting this starting the day or whatever other strategy you want to use to make money on the downside, and you were making your money. And if you timed it right, you get out down here. If you didn't time it right, when it hit its VWAP, you basically got out of your short position. Hey, and then maybe even once it got above it, and I love it when it does this. It comes up and then it tests that line again a little bit. That's a good sign. Maybe you wanted to go long in that day. Again, this is all in the context of one day. So by noontime, maybe you went long and it made money, and somewhere towards the end of the day, you're selling out, and hopefully you made money in your short, and then in the afternoon, you made money on your long, and welcome to the world of day trading. It happened this day. It shot up above the VWAP, and then immediately kind of rested just below it. Again, it's debatable whether you would have taken that or not because it's not really moving a lot below it, but that's not part of this conversation. But that's basically what VWAP is. Today was an interesting day. It really exploded outside of above the VWAP. Somewhere in here, maybe this long string of candles, who knows? It might have told you to get out, and plus you're using other indicators beside this. But there you go. There was some nice money. What is that for this day? If you bought, so usually I'll wait till after the first candle. So the first 5-minute candle was positive. So say you bought it in the second 5-minute candle, and if you time this just right, you got 3.28%, and even before noontime. But even if you waited, you still could get like 2%, 2.5% even if you waited into the afternoon. So whatever happened here, I mean, there was some good money on a day like that for a day trader. Not my thing, not Jeff and I thing, but that's what VWAP is. So now let's bring this over to, let's turn VWAP off, and then let's turn this chart back over to a daily chart, and let's use VWAP. So now let's talk about anchored VWAP. So anchored VWAP is basically, it's kind of the same thing. It's a dollar cost average from the anchor point. Now, what is the anchor point? So the anchor point is a starting point or a trading day other than the current trading day. It's a VWAP, so the daily trader's VWAP, anchored to an event like earnings, price gap, volume spike, a recent high, a recent low, a news event. So whatever point you deem worthy, and it's a very subjective thing, that becomes the anchor point. So basically, when you set your anchor point, this becomes the dollar cost average from that anchor point. So let's go ahead. I'm going to set anchor point on the earnings. That's something I do because I want to. So here we go. I'm going to do an anchored VWAP. And I just like to look at this at dots when I'm setting the VWAP. So this was an earnings day back in May. There you go. There's one. Let's do another anchored VWAP on the next earnings point, which was late July. And then finally, there was one recently, right there. I don't like that color, so let's go over to red. Okay. Now, let's just look at this alone, and then I'll add a few more to this. Candlesticks. What's this telling me on the anchored VWAP? So my anchors on the earnings are telling me that the May earnings, I could go back and look, but I'm willing to bet you they weren't that good. Also, a stock could be moving down because of the macro conditions, not just the stock itself. Obviously, I think all ships move with the tide. But that said, this is suggesting to me strongly, and I put some money on it, that if you went back and looked at the earnings in May, they weren't that good. People weren't happy with the stock, and sellers were in control since that point. Then in August, these earnings came out. Boom. She moved up above. She did test it, come down below. This candle right here was a very strong candle to tell you that it's going back up because of the long wick on the bottom. So that's like a shooting star. And boom, she moved up above. And since then, she's been above the anchor since that earnings. And now you know buyers are in control. She had another earnings at the end of October. Again, got tested a little bit. Maybe some people were taking profits, whatever the story is. It moved up above, and wham, we got this going on all the way up to today. So this PayPal is actually on my watch list. You know why? Because down here it was red. It got on my list because it went through my filter as something in consolidation because the TTM. And today, what is today? November 11, Veterans Day. Thank you for all you have served, by the way. You've given us the ability to do these wonderful things and just worry about the superficial stuff like making money. So God bless you all. But that said, this popped today, and this was on my watch list. And in my next video, I'll probably be putting this one on a buy list. Jeff, FYI to you. So there you go with your anchored VWAP. Now I can add other anchors to this, and I typically do when I'm doing my analysis. So let's go back to adding some more anchors. I want an anchor off the recent low, which is that dot right there. I want an anchor. I like to put anchors off the recent highs, not including today. That's the high. And now I will save this. If I were doing this, for my own, for real, I will say this to know that you can look at it from earnings, you can look at it from the low, and you can even look at it from the most recent high. The buyers, let's get this back over to candlesticks. The buyers are in charge. This is green light city just on TTM and anchor VWAPs alone. All right, let's get into the final of my three cornerstones is basically my lucky 13. So I call it my lucky 13 because it's mine. It's a proprietary technical scoring system developed by me. I use it to score stock or security considerations. So in addition to VWAP or anchored VWAP and TTM, actually TTM is technically one of the 13, but that said, there are many other indicators that are now here on the screen before you that I use to judge whether I want to go into this stock or not. So I'll cover them real quick. Again, I'm trying to make this as brief and painless as possible. Basically, the score is based on 13 indicators, hence lucky 13. I love the number 13. It's lucky for me. And I have chosen these indicators. They are most meaningful to me and selected to complement each other and to avoid redundancy in the information provided. A lot of technical indicators out there are feeding off the same data points or the same information. They just present it to you in a different way. You got to be careful about that because all you're getting is confirmation of the same thing you just got confirmation on. So that's not helping you. You need diversity and looking at your technicals from different angles. So I picked these based with that in consideration. So my lucky 13, first and foremost, price. That's the most important thing. What am I buying it at? What is that price compared to where it was? So price is the first one. TTM squeeze, talked about it. 200-day simple moving average right here. You want things above the 200-day, clearly. 50-day moving average. You ideally want things above the 50-day moving average, and you really want your 50 above the 200. Something that is very interesting. Let's see if I can. Hold on one second. Let's make the candles invisible. There we go. This 50-day moving average came down and kissed the 200. Now, had it crossed, it would have been known as a death cross in the industry. And then it crossed above, which is a golden cross. So obviously golden is good. So there's your golden cross. It's moving up. And there is a divergence between the 50 and the 200, meaning that the 50 is breaking away. So that's all good signs, right? Just on those, I don't even have prices on this chart right now, and I'm just looking at moving averages, and this is just saying, wow, this is really strong stock, and I'm not even looking at price. So let's go back to candlesticks. So then you have your 5-day SMA, or simple moving average, which is this blue line right here. And I always want my 5-day SMA pointing upwards if I'm going to go into a buy consideration. I really don't want to buy it when it's pointing down. I can go into that some more in future videos. I'll explain more because I look at different time frames. That's another thing I'll say. I look at weekly. So when I'm doing analysis of a stock, I'm looking at multiple time frames, and that's important when you make a decision. I need to know on a weekly basis, if I'm looking at a stock over 3 years, where does it stand with respect to itself over the last 3 years as far as the trend? I need to know on a daily basis where it stands with the trend. And quite frankly, when I go ahead and want to do the trade, I'm going to look at an intraday chart. And I like the 39-minute chart. I'll explain that in another video. But basically, there's 390 minutes to a trading day. So if you break it down to 39 minutes, it's 10 equal candles. Whereas if you did 30 minutes, they're not equal candles, et cetera, et cetera. So I look at the multiple time frames. But here we are on the daily, and my 5-day simple moving average is pointing up. I look at Bollinger Bands, which I covered as part of TTM. There we go. That's the standard deviation. You can tell when it's overbought or oversold. We talked about this oversold point would have been a good buy if you acted on it. And then there is what is known as the Ichimoku cloud. I know it sounds funny, but whatever. That's basically this cloud right here that just showed up on the chart. I'm not going to go into it except to say that it offers as resistance or support, and it also kind of gives you an indication of the trend because this cloud's pointing up. So right here we had a kind of a little bit of sideways action on the cloud, but you can see here where it broke through its cloud, and the thickness of the cloud does matter. So if you have a stock coming into a thin cloud area, it's probably going to break through that cloud pretty easy, and it did. And then it came down and it tested the cloud, and the cloud was thicker and it acted as support. Beautiful. That's what the cloud does. And then it bounced back up, and then it came down and tested it again, kind of got bogged down in the cloud and even moved below the cloud, which is not good. It did find support at its 200-day moving average. So if I was making a decision at this point, I might have waited. It came back up, tried to break through the clouds, did find a thinner spot to do that, did try to break through the clouds, but ultimately these long candles, especially when you get 3 of them in a row like that, that's not a good sign. And definitely when it broke its 200-day moving average right here, that's not good. So it moved below the cloud. So here it is now through June and July and coming into August. It got some momentum and came up through the cloud. Went down and tested it again, and finally got above the cloud, and it was home free since then, and it's been a wonderful thing since then. So the cloud helps me to identify where support and resistance may be, in addition to, and then finally which way the cloud's pointing also helps me with the trend. All right, now the next one is on balance volume. On balance volume is this line right here. I won't go into it more except for that it helps confirm that the price action is matching the volume action. Prices that go up on low volume aren't that meaningful. So you want to see prices move up with some meaning behind it, meaning the volume is there. There's a lot of buyers associated with that. So that's what the on balance volume helps me with right here. Another indicator, or part of my 13, is the ADX, or the average directional index. Again, for simplicity, let's just say that if the green is above, it's an uptrend, and if the red is below, or excuse me, if the red is above, it's a downtrend, like right here. This is in an uptrend, and this blue line tells me the strength of that trend. I want the strength to be above a 20. This has been on a strong trend for a while. We know that. And even today's action made this little U-turn on the strength indicator. So this is not only an uptrend, but also it just turned in, it's pointing to be even a stronger uptrend. Moving average convergence divergence is MACD. Won't go a lot into it except that I want to see these histograms green. I want to see this thing moving from here and moving this way, from here moving this way, crossing that line. That's what I want. That's another indicator. It's another point in the scoring system. Relative strength is the strength relative to itself over the last 14 days. Different days can be used depending on the trader. I use 14. 14 is very common. When it's in the upper part of the range, meaning it's on the stronger side of its strength compared to itself over the last 14 days. And again, here it is very strong. Another good positive sign for this PayPal stock. Chaikin money flow basically tells you whether it's under accumulation or distribution. This slope has gradually been moving this way for a while. So this was all sell-off territory, but the sell-off pressure was being eliminated, and then it became buying pressure. So this is all a good sign. Now, yes, it has moved this way a little bit, but it's starting to curve again. So I'm happy with that. And then finally, RRG. I'm going to go into that in another video sometime in the future. It's a very fascinating indicator. But what this is basically is it's a relative strength ratio, the orange line, and then the momentum of that relative strength, the blue line. So it's kind of like in a car, it's a difference between speed and acceleration. You're going to get the acceleration first before you get the speed. So the blue line will have a tendency to cross over the center line. And what does that center line mean? It means what is the relative strength of this particular stock, and then the momentum of that relative strength of this particular stock against a set benchmark. Most people will use for large stocks, if they're analyzing large stocks, they'll use S&P 500. I use the total market index, which is VTI. It's a Vanguard total market, and that's what my benchmark is for this. So basically, this is telling me this stock right now, both the momentum and the relative strength is less than VTI total market. But given all the other positive signs I just went over in this particular example, I'm not going to let that one indicator dissuade me from wanting to get in. I do like to see that blue kind of turn a corner here and get above that line. But that said, that's what RRG is all about. And that basically takes care of the Lucky 13. Okay, that's as far down the rabbit hole as I want to go for today. As I said before, I know this video has been exceedingly long. It's much longer than I will for my others. Like, there's a lot to explain in my inaugural video as to how I go about what I'm doing, so that you understand when I'm on other videos and referring to these things. I've already kind of covered the basics, at least in this opening video. I will go into a little more detail while I'm analyzing stocks as to what I'm looking at. Again, not nearly as long as today. But for now, what I've shared, it covers the introduction to Simplicity Investment Watch. As I mentioned at the beginning of this video, my future videos will get right into what's on the watch list, what is moving to the buy list, what is coming off of both, and what we are buying into. So I anticipate that we will have at least 2 to 3 video updates a week. Besides this YouTube channel, I will eventually share these videos and basically as a value add, I'm going to offer charts and lists on the website. So the website will give you a little more without, you can watch the video, of course, but it'll actually provide some lists so you can look at to say, hey, this is what we're watching, this is what we're buying, this is what we actually bought, this is what we sold, and we took a profit or we took a loss on, but we'll have that up there, just being transparent on those things. Yeah, and that website basically is right here on your screen, www.simplicityIW.com. It's not live yet. You don't have to go there. It's not live yet. I'll let you know when it is, but that's under construction. If you have questions or need to reach out, my email is right here, mark@simplicityIW.com. Shoot over your questions or any feedback or comments. Greatly appreciated. And I want to thank you for your interest. I want to thank you for your time. Please click on subscribe. By clicking on subscribe, it will help in letting you know when new video content is put up, and that will help me gauge interest as I commit to doing more of these. Once again, thank you very much. Thank you to all our veterans. Today is Veterans Day, and remember, keeping things simple is really smart. All right, take care, everybody.